Let's talk about loan-to-value ratio, or LVR. The way I explain it to my clients, loan-to-value ratio is the percentage of the loan against the value of the property. It's actually the loan amount divided by the value of your house. Let's put it this way. You have an 800,000 loan, and the value of your property is 1 million. So 800,000 divided by 1 million is 80%. So the LVR is 80%. If the loan amount was higher, like 900,000, then the LVR is 90%. Or if the loan amount is 700,000, the 700,000 divided by 1 million and the LVR is 70%. Why is it important to understand loan-to-value ratio? Banks have that sweet spot in terms of interest rates. So interest rate may vary depending on the loan-to-value ratio. An 80% loan-to-value ratio means you will get very competitive interest rates from most of the lenders. If the LVR is higher, let's say if you go up to 90 or 95%, then the interest rate is a bit higher than what you'll get from an 80% LVR. Probably a 0.5% difference. That's high because a 0.5% difference will also increase your monthly repayment. A lower LVR, anything lower than 80%, like let's say 70%, will also attract an interest rate discount, probably another 0.10% interest rate discount. So the rates will vary depending on the loan-to-value ratio. That's the first reason why you need to understand LVR. A second reason is there are postcode restrictions, and there are postcodes in which the banks will tell you that this is the maximum LVR they can go to. There are also property types in which banks wouldn't go over 80% loan-to-value ratio. Let's say if you're buying an apartment in the Melbourne CBD or Sydney CBD, there are certain postcodes in the cities in which banks will only go up to 80% loan-to-value ratio. And sometimes, if they're high-density apartments, more than 100 units in the complex, then they can only go up to 70% loan-to-value ratio. This happens in the cities or anything closer to the city, like hubs in which there are, a lot of apartments and buildings in the area, mostly high-density. A third reason why you need to understand what loan-to-value ratio is that when banks lend for owner-occupied purchase, like a property where you intend to live in, they can actually go up to 95% loan-to-value ratio, like houses. But do remember, the postcode restrictions or the property type restrictions still apply to the LVR. And then, if you're purchasing an investment property, banks can only go up to 90% loan-to-value ratio. Another thing you need to understand and need to be aware of is that a lot of banks will only go up to 90% loan-to-value ratio for construction loans. And so you need to have the 10% deposit and further funds to cover the LMI, which is roughly around 2%. I have 2 lenders, or 3 maximum, in which you can actually purchase a block of land and do construction up to 95% loan-to-value ratio. But there's just about 3 lenders. And then I've got 1 more lender in which you can actually go up to 97% for a construction loan. But you have to remember there's restrictions, there's certain requirements or conditions that we need to meet for you to be able to go to those lenders. So before you actually make a purchase, get a pre-approval, speak to your broker. Broker will understand what you're planning to do, what you're trying to buy, and give you proper advice on what kind of properties you should be buying, how much deposit you need, and then how much you can borrow. And then you'll have an idea how much, what your purchase price will be. Thank you for listening.